So you said that, for the non-dilutive financing, like the lenders have like a specific type of businesses they are like happy to lend to, and then there are specific type of businesses, let's say online businesses, which is, they're more skeptical about. So can you tell us more about like, anything there, how we could maybe position it as, like especially online businesses?
Yeah, I mean, it really comes down to, does the business have any collateral? So if the business dies, can the sellers get paid back? Sorry, the lenders, can they get paid back? And usually online business doesn't have collateral. E-commerce does, so e-commerce usually finds it a little bit easier, and SaaS finds it easier. So that, which brings me to the second point. The other thing that they look for is really the strength of the revenue, like how robust is the revenue, how reliable is it. So SaaS is funny because they have recurring revenue, and they can, like, technically you can cancel a SaaS anytime. So, in theory, the revenue is not, it's not like people are signing 1-year contracts for most software businesses. But you can see, you've got 1,000 customers, they pay every month. Maybe you lose 4 customers every month, but you're gaining 4 or 5 every month. So those lenders feel a lot more comfortable, and they'll typically lend a larger amount. And there's more things available. Like, there's more companies out there who will fund this type of business. What's harder is if let's say you have like an agency business or a digital product business that there are all these one-time sale, there's no recurring revenue. The other thing they look at is customer concentration. So maybe you've got 15 million revenue, but 10 million comes from one client, and that client doesn't have any contracts or anything. Like, they could cancel tomorrow. So they're really asking themselves, what's the risk for us? So if the business, how likely is the business to die? Like, okay, it's got recurring revenue, you've got thousands of customers, people usually stay for 7 months, you don't have a very high refund rate or churn, and it's very consistent, very like smooth revenue. There's no seasonality. Like that is generally good, and they understand software businesses. Whereas if you're an agency that might get paid like 300K by one client in January and then nothing again until the following January, and then you've got some other clients spending some money here and there, and meanwhile you have expensive contractors who are doing all the work, and one of your clients is 30% of your revenue, another client is 20% of your revenue. They're going to look at this and think, this is quite risky. So they might not lend to you at all, or they'll lend you less capital, or they'll lend it to you, but they'll have like a more aggressive payback schedule. So it's kind of a whole combination of things they look at.
Yeah, I think at the end of the day, everything boils down to the risk. You
Yeah.
have lower risk, you get better terms. You have lower risk, the buyers are willing to pay more for a business. Like, everything is boiled down to the risk.
Yeah.